Many lenders will be reluctant for you to give a debt instrument in the form of a dividend or a bond or a high interest loan that is in the back end of the capital stack. We'll use the $1 million deal. It's a simple number. Everyone can understand it. Say the lender's going to give me $800,000. And then say I'm going to raise another $300,000 off the street from investors. If I go to those investors that are each, let's say 3 investors are each going to put in $100,000. If I go to them and say, I'm going to give you a 20% return per year, which is a good return. I mean, heck, you could probably give away a little less and still get the deal done, and the investors will probably go for it. But let's say you're feeling real generous. I'm going to give you a 20% per year return. If you try to make that a debt instrument, a second position debt instrument, there's a good chance the banker is going to look at that and say, do you know what? We don't like this structure because you're making a formal obligation to this person that's subordinated in the capital stack. And all debt obligations eat at the DSCR, the debt service coverage ratio. That DSCR is the holy grail number that the underwriter and the bank, they're all looking at that number. So what you do instead is you essentially give some equity at the sub instead of giving a dividend promise or a subordinated debt promise. Now you can do a base 8% promise or a 5% promise. You can still make a debt promise, but just know that that's going to make the lender more uncomfortable than will giving an equity stake in the subsidiary. And maybe the top co, if you're really feeling generous, though, try to do as little of that as possible, if at all. But when you give an equity stake at the sub, now the investor's truly just that, an investor. If the business is profitable, if there's a lot of earnings, the investor is going to get a pro rata part of the distribution. You can talk to your lawyer about this. You can Google this stuff. This is a little bit wordy, but it's really not that complicated. And by the way, we're recording this, so everyone can refer to this after the fact. But what you can do is and what I recommend you do to get your first deal or two done is give away the equity at the subsidiary and maybe give away an arbitrage, a 1.5 to 1 arbitrage, a 2 to 1 arbitrage if you're feeling really lucky, you're really generous. And what's an arbitrage? What am I talking about? Again, let's use the $1 million deal. Say you're raising $100,000 to do a $1 million deal. All right, you're raising 10% of the capital stack in cash. Well, what's 100,000 divided by a million? Obviously, it's 10%, right? It's 1 divided by 10. Pro rata, basically a 1-to-1 equity arbitrage would be saying, hey, you're putting in 10% of the money for the $1 million purchase, so you're going to get 10% of the equity. An arbitrage is saying, hey, buddy, you're putting in 100,000 of $1 million. You're basically putting in 10% of the capital stack. But because I want to have a future relationship with you and we know this deal is going to be super successful and I wanted to sweeten the pie and make this a no-brainer for you, we're going to give you a 2-to-1 arbitrage or a 1.5 to 1 arbitrage. So a 2-to-1 arbitrage, if the guy puts in 100,000 and it's a $1 million deal, basically says you put in 10% of the money, you get 20% of the equity. Now that sounds immediately like a deal, doesn't it? Where can you buy a stock for 50 cents on the dollar on the New York Stock Exchange or on the NASDAQ? The answer is you can't, generally. So the arbitrage is the simplest way to get that jaw drop. And really, I think what you were hitting on, Albert, that I think you're right about is you have to have something sexy about the investment that makes people double take, right? You need to have the six-pack abs of the investment community. And so while you should talk about the great sector you're in, the great team you've put together, the wonderful deal that you found, preferably off market, which makes it that much more exclusive, the way you create the wow experience, from my history, has been the arbitrage. Somewhere between 1.5 to 1.75, maybe 2.0. And if you're only raising 5 or 10% of the capital stack in cash, you can give away a 1.5 to 1 or even a 2.1 arbitrage. And Topco, your parent company, where you're holding the majority of the equity, can still keep 85 or 90% of the deal. And this is actually precisely what's going on with us right now. We gave away 15% for this deal that's going to close in a week. Should close in a week. It might close the following Monday, but it's going to close. I bet my testicle on it. We gave away 15%. Well, we raised about 6.5 to 7% of the capital stack in cash. The numbers have changed, but it's about 6.5 to 7%. We gave away a total of about, I think about 13% of the equity at the subsidiary, which means Topco's keeping about 85 or 87% of the deal. Yet our investors, we gave them an arbitrage. And so here's what happens. I didn't put in any of my own money. My team didn't put in any of our own money. We're still keeping over 80% of the deal. And yet for the investor, because we raised only a small portion of the capital stack in cash because we had seller finance as a second position note, and because we worked with the SBA and got a high leverage first position note, the investor got a sweet arbitrage, and we're keeping the vast majority of the deal. So that right there in a nutshell is how you do win-win deals for both yourself as the general partner, the guy that puts the deal together, leads the investment team, but also the investor. And if you get a great high debt service coverage ratio deal in a good sector, then the lender looks at it as a win for them as well, because there's a lot of free cash flow. Ostensibly, you put together a strong operational team that conducts themselves appropriately, and everybody wins, is the nutshell. So that's the big picture, how I've raised money and how I would implore, that's from the real, this is a guy who's doing it. A lot of these people talk on the internet. They don't do it. Not all of them. Some of them do. Not all of them. This is the real deal.